To kick off our podcast today, we wanted to ask you a really important question. You've probably got a good idea of how much money you have saved for retirement, but here's the question. Do you know how much you'll owe in taxes when you're retired? Do you know how much you're going to pay on taxes in your IRA or 401k withdrawals? Do you have any idea how much you're going to be paying in taxes on your Social Security benefits? Or for that matter, any other investment income from interest, dividends, or real estate? This is the most important number you need to know. And I would say 9 out of 10 people, if I just ask somebody walking through our doors, they would say, yeah, I've got this much money. I watch it every single week and I know how much is sitting in all of my portfolios. But if you don't know how much money you're going to be paying in taxes in retirement, well, you have no idea how much you can spend in retirement. And here's the thing, 99% of all people grossly underestimate the amount of money that they're going to owe in taxes when they retire. They aren't even remotely close. And it's critical for you to understand exactly how much you'll owe in taxes, because we can pretty much guarantee this is going to be a bigger number than you realize. So on today's podcast, we're going to break down different ways your retirement income gets taxed. We're going to be talking about where people get themselves into trouble, because we've seen this thousands upon thousands of times. And the last thing we're going to be talking about is the single most important strategy that could save you a small fortune all through your retirement years, just in taxes. In our last podcast, we talked about 5 different things that really make a difference in your retirement. And we had such an overwhelming response to people wanting to have more information about the tax section of our podcast that we thought that it would probably be a good idea to break this down and to have a whole episode just on taxes and what the importance of it is. So Ryan, it may be good from an overview perspective to talk about buckets of money and how these different buckets of money get taxed and how you ought to be thinking about it. Because I think a lot of times people get all of these different places that they have their money. They may early in their career have a 401k one place, and then they go get another job and they have another 401k. And then somebody tells them that they need to start saving in an IRA. So they start doing that. And then somebody says, hey, CDs at the bank are a really good idea right now. So they put some money aside in a CD that they're hoping that they can have some guaranteed income in. And all of a sudden, before they get to retirement, there's all of these different jumble of accounts, and they have no idea how any of these are necessarily going to get taxed. So can you go into that a little bit, Ryan?
Yeah, let's give you some framework, because literally the IRS tax code is tens of thousands of pages, and we could put you to sleep going into the technicalities. And so one of our superpowers is simplicity. So let's give you a frame to think about all of your money. Really boils down to 3 buckets. And when you look at how are things taxed, what is it going to look like, and how do I know when tax man's coming? How do I know if he's coming now, or how do I know if he's coming later, or even better, how do I know if he's never coming? So here's the 3 buckets. Bucket number 1 is your taxed always bucket. Bucket number 2 is your tax deferred bucket. So that means you're going to be taxed later on it. And then there's bucket number 3, everyone's favorite bucket, is the taxed free bucket, or for compliance reasons, we'll call it the taxed rarely bucket, which most of the time, if you do it right, it's going to be tax free. So let's just give you some examples in each one of these 3 buckets. Taxable, tax deferred, and tax free. Well, if we look at the taxable bucket, you always recognize this bucket because you get a W-2 or a 1099, or if you're a business owner or have different investments, you're going to get a K-1. What that means is you got to pay some money to Uncle Sam. We're giving you a form that says we're giving notice to Uncle Sam that you made some money somewhere. So obviously, a simple example of that is your paycheck. Uncle Sam has figured this out really well. He knows how to take the money out even before you get the money, right? It's because he wants to make sure he gets paid. So that's why they created this thing called auto deduction from your paycheck. And you just see this happen, and before you could even touch it, Uncle Sam's gotten his piece. But then there's, then there's things like a bank CD. You put the money in there. You don't get a paycheck every month, but what you do get at the end of the year is you get a 1099. It's the I'm telling on you form that says, "Hey, Uncle Sam, Tyson made some interest, so you gotta get some money out of him."
You got to pay it in the year that you made it, right?
Yes. Then there's bucket number two. The easiest example of this is IRAs or 401ks. That's what most people are familiar with. But maybe you work for a government entity or you work for a school district and you've got, we just call it the alphabet soup, 401k IRA or 403b or 457. There's all these government sponsored tax deferred programs, and it's just tax deferred. Tax deferred simply means you're just kicking the can down the road. It's not like you're going to get this is going to be tax free, but it's going to be taxed later on down the road. And then Tyson, there's Nirvana. It's the place that everyone wants to be. That's the tax free bucket or the tax rarely bucket. And this is your Roth accounts. This is your tax free municipal bonds or your tax free bond funds that you can find. Or it's life insurance, properly structured life insurance that allows you to take the withdrawals out tax free. It's pretty restricted in this bucket. And Uncle Sam loves to make more and more restrictions for this bucket. So those are your tax buckets. Now, Tyson, I think it could be helpful here if we go into a little bit more detail on the different types of income, and where people get in trouble. I think that's a really good place. How do you avoid getting in trouble on all these different buckets? We just simplified tens of thousands of pages into 3 buckets, but Tyson, let's talk about where people get in trouble and why.
Yeah, this is exactly where I wanted to go, Ryan, because people get lulled into this sense of security. And you mentioned it a few minutes ago, Ryan, where you said the government's really good at getting you to get an automatic deduction out of your account. And you think to yourself, man, this is awesome because when I get this deduction taken out of my account and it goes automatically into my 401k, I set it and I forget it. I just know that I'm going to get a tax deduction when I look at this at the end of the year. I didn't have to pay any taxes on it. It's really efficient. And so you get lulled into this sense of security because whether it's a 401k or an IRA, you're just setting all this money aside in a tax efficient way where you get a deduction. And then all through your retirement years, all through your working years, you also get the growth in a tax deferred bucket. You're not paying any taxes on it. And so you just think, man, this is so awesome. This is the best thing ever. And then you get closer to retirement and you hear this 3-word piece from your financial advisor, or you read it on a government form, a IRS form, and it's RMD or required minimum distribution. Well, it may have been the first time that you ever started thinking, what does this mean? And so the next piece that the government or your financial planner says, don't worry about it. It's going to be down the road. Right now it's at age 73. And so, if you're 62 years old right now and you're going to retire at 67, you've got plenty of time. Just keep growing your money. And when you get to retirement, we'll start worrying about it. Well, for us and the way that we think about this, we feel like that's too late. That if you just start pulling money out and start paying required minimum distributions when you get to 73, that there's a much smarter way to take care of taxes. And let me even build some more framework around this. So it's not just your IRA or 401k and required minimum distributions that you have to worry about. You also have to worry about your pension and how you're going to be paying taxes on your pension. Because if you pull money out of your pension, then you're going to be paying taxes on that every single time that you pull money out at whatever your tax bracket is. When you pull money out of your 401k and IRAs, if you do that right after you retire, it's not an RMD anymore. You're just paying taxes at your current tax rate. When you start pulling Social Security out, for most Americans 30 years ago, they didn't pay taxes on their Social Security. Well, now because of inflation And because of the way that the government looks at Social Security and not changing the amount that you're going to have to pay taxes on, now the majority of retirees are paying taxes on up to 85% of the money they pull out every year at your standard tax bracket. And so all of this comes as a surprise to most people, but there's a better way. Our goal at B.O.S. Retirement Solutions and Advisors is, in fact, to not have you worry about required minimum distributions. And even if we can do this before you retire in the right way and adjust from a tax planning perspective, you may not pay taxes on the majority of your income that you pull out in retirement. Ryan, how do we do that? And it's nothing that we're doing that's up against some illegal structure or anything like that. It's just following how the government looks at taxes and you understanding how it works so that you can benefit from that structure, right?
Yeah, I was just thinking about a family I met with one time, and his plan was to take Social Security at 70 when he came in, and he was living off of some interest when he came in and saw me. So he was about 65 when he came in and saw me, and he's like, "Hey, my taxes aren't that bad. I'm paying like $15,000 a year in taxes because I'm just living off of interest, and so I feel like I'm pretty good. I don't feel like I really have a problem." Well, the problem was he had this giant um, IRA and 401k from when he was working, and he wasn't looking at the long-term effect of this. And so I showed him with the software we have. We run a forward-looking tax analysis on the retirement accounts. Now, as we do this, remember, we're not CPAs, we're not tax attorneys, so we're not giving you tax advice here. But what I want to illustrate just in simplicity is what the looming avalanche of taxes coming down the road was. I was able to show him, okay, your taxes are 15,000 right now. That's not that bad. But look what happens when you add in Social Security at age 70. Look what happens when you have to start taking required minimum distributions. All of a sudden, his tax bill bloomed and blossomed from $15,000 a year to $150,000 a year. And that tax bill was going to go up every single year as the RMD, or the required minimum distribution, started getting bigger and bigger. And so I'm like, it's not what it is today, it's what it's going to grow into. And by the way, that's at historically low tax rates on a 40-year low. What happens if Uncle Sam raises the tax rates? Well, that 150 is going to go to 175 or to 180, and it's going to get even bigger. And so that's what we call the avalanche of taxes that can happen. And so this is really where the planning piece comes in. Tyson, let's talk about what are some of the strategies that we love to just look at and say, how can we minimize this tax bill?
Well, the first one is considering converting to a Roth. And Roths have been around now for quite a few years, but most people still are not using them. And the reason why is a couple. First off, it's just recently been that anybody had access. For most people listening right now, in the last year or two, it's the first time that you have had access to a Roth 401k. Some of the rules and regulations changed, and by now you should be seeing an option in your 401k to be able to put in money into a Roth account in your 401k. Also, a lot of people, the second reason why people don't think about it, and then I'll talk about the tax ramifications in all cases, is that they hear this rule that says, hey, if you make X number of dollars, then I don't qualify for a Roth account. I make too much money, or my spouse and I make too much money, so we don't even have access to it. Well, there's some other ways that you can have access to a Roth, like a 401k or what we call a backdoor Roth. And let me explain how taxes work with a Roth just before you get all excited and go start moving around money. What really happens here is, if you're so used to a 401k or an IRA where when you put the money in, you get a tax deduction and then it grows tax deferred, it works a little bit differently with a Roth. With a Roth, let's say that you're putting it into a Roth 401k as an example first. You put that money in, you pay the taxes up front at whatever your tax bracket is. But then here's the key. You pay it now at 40-year tax lows that Ryan just talked about, and now it grows tax deferred. And then when you pull the money out, whatever growth has happened on it and whatever the original amount you pulled out or you put in, you don't pay taxes on that money ever again. So you have no required minimum distribution on that. So really, this is a strategy to help you to save money at 40-year lows in taxes and then be able to whatever the taxes look like in the future. And as we now approach in the next 10 years, $50 trillion in national debt, and taxes are really the only revenue stream that government has access to pay for anything. Do you think taxes are going to stay lower or taxes are going to stay higher? In a public event, when we ask that question, 9 out of 10 people raise their hand and say, absolutely, taxes have to go up. So wouldn't you like to make sure that you have access to lower tax rates now versus waiting until later and having to pay higher taxes because the brackets have gone up? And really, this goes back to what we call tax bracket management. Ryan, how does tax bracket management work? Let's maybe give an example of our favorite tax bracket and why.
Yeah, our favorite tax bracket is the 24% tax bracket. Now, everyone's always waiting for us to say, your favorite tax bracket is the zero. It's not. It's not the zero, because if you have $1 million in an IRA or 401k, you're going to pay some taxes. But the reason why we love the difference between the 22 bracket and the 24 is it's such a small increase in tax, but you get a big bang for your buck when you do the planning in that. So let's say that you've got $1 million in your 401k and you want to convert it over to a Roth. Well, the strategy would be over a series of years. Let's say that we do it over 5 years. We bring $200,000 a year for 5 years. So that's the total of $1 million. And we optimize up to the max cap of the 24% tax bracket. So we look at your income, we look at other income sources that you have, and we maximize that bracket. And so we're all of a sudden able to go from the 22 to the 24. So for only a little 2% higher tax on the federal side, we can get out a lot of money. And then over time, we can get that all over into the tax-free bucket. So for most people, what they'll do is they'll just deduct their taxes when they do that conversion, have that paid for, so there's no money out of pocket. But then they start with that, what's left over, they put that in the Roth. Now all of that growth is tax-free. It's compounding tax-free. When you take it out, it's going to be tax-free. So that's not going to affect your Social Security income. That's not going to impact any other income source. And there's a lot in this, and we don't have enough time to go over this, but this is basically not a do-it-yourself project. Because imagine this. Imagine, and this is kind of where we want to end the show today, is imagine having a tax strategy that could save you a fortune just by doing what we call the compound tax saving strategy during retirement, where we're looking at Social Security and we're looking at your IRAs and 401ks and we're looking at your other investment income, and you have somebody on your team optimizing this and then bringing in great partners like a CPA to help you really dial this in for the exact pieces of it, and make sure that you can optimize this to the best possible scenario for you. This is when you combine all this together, where it ends up being tens of thousands, hundreds of thousands, maybe even millions of dollars, depending on how much you've saved for retirement in tax savings. This doesn't require risk of taking more investment risk. This doesn't require, some complicated strategies. This is simply slowing down, being intentional, and having a plan. And unfortunately, Tyson, where most people get in trouble is they just don't take the time to do it. And they're just like, oh, there's nothing I can do about it. Or, this seems really complicated. Well, yeah, it is complicated if you're doing it by yourself.
They keep putting it off, right?
Yeah. So Tyson, I just love that picture. Imagine going in because you did some planning. Imagine instead of stressing every year here at the end of the year, you just know that your strategy is going to be on autopilot. It's going to work, and that you're not going to get a huge chunk of your hard-earned retirement savings taken out of your account needlessly, because you have a plan and a strategy which gives you confidence. That's powerful.
And what I love about this confidence is it's a tax plan that not only helps you with your IRA and 401k that we've focused on, but it helps you to save money on your Social Security as well. It helps you to make sure that you're not paying too much in Social Security or on your pension. It allows you to, we can plan for your, when you turn on your Medicare, that you're not paying too much premium for your Medicare, because most people have no clue that as they get near their retirement years, if they're not looking at all the income streams added together and it pushes them up over certain limits, then what ends up happening is they end up having double the Medicare premium payment just because you earn too much income. And so the government said, hey, look, you're going to still get the same Medicare as everybody else but you have so much income that you're going to pay more for it. And there's no reason to. If we can do the planning for you, if we can help you to look at all of the picture instead of just a portion of the picture, then you're going to have a lot more money that stays in your pocket. Now, we're not saying that, again, Ryan mentioned zero is not necessarily the case. If you're at a zero tax bracket, there may be some things that you're doing that the IRS is going to come knocking on your door and say, there's some tax evasion here or some things like that. This is all about using the tax code just in general ways that the code has been built to benefit you if you are in the know. And all we're doing is trying to show you how taxes can work in your favor instead of against you, because everybody wants safe streets. They want police. They want great teachers. They want to make sure their roads are built correctly. They want to make sure that they've got emergency services so that you've got an ambulance coming if you've got an emergency. All of that is definitely necessary when you're looking at paying your taxes. But there should be no reason why you should pay more than your fair share, or pay something that you didn't even know that you had the ability to adjust and keep in your pocket. So that's what this is all about today, is really showing you and helping you to be, there's book smart and street smart. To us, this really boils down to understanding how, from a street smart perspective, how tax code works so that you can save money and put it right back in to your pocket.
Well, and Tyson, hopefully, as we've just had this conversation, as you're listening to this, hopefully you've been able to see that tax planning for retirement could be a really important tool for you. This is one of those ways that could help leverage your money and make it go a lot further in retirement. And, the first thought oftentimes is, I'm not going to talk to my uh, investment advisor about this because I need to go talk to my CPA or accountant because, they're going to be the ones that will help me with that. They're definitely the professionals that need to prepare the forms and do all the right things. But on the strategy, remember, most CPAs and accountants are simply thinking about preparing the forms. They're not necessarily thinking about strategy. And so if you think about it, this is backwards. Your CPA, they're looking backwards and they're simply just reporting history. When tax planning for retirement, we recommend that you look forward. And your CPA is trying to help you save money on taxes last year. So as we get to the end of the year here in 2025, most CPAs are like, okay, what can we do at the very end? Well, that's good, but that's going to have some deductions that can save you a few bucks. Tax planning is literally for the rest of your life. And, it's important to recognize the tax planning for retirement. It's very different. And that's where at B.O.S. Retirement Solutions and Advisors, we help you just start that conversation by our forward-looking retirement tax savings analysis, where we look at this big picture. We have the software, we have the tools to be able to take a look at this, and then you can make a great decision. The best part of this is we run this analysis for free, even if you're not a client. And so, this is one of those things. You do have to have some money saved for retirement. So if you save at least $300,000 for retirement, that's where you're going to look at. But you can get this analysis for free. So we'd invite you to give us a call, 800-769-7550, 800-769-7550. And this is one of those things that it's not the time crunch to do by the end of the year, because this is something that tax planning is a year-round sport. Most of our slots are filled up right now, but You may be able to squeeze in first of the year if you give us a call real quick, but we want to help you to be able to make a good decision, because in B.O.S. Retirement Solutions and Advisors, we believe that good information to good people, it allows you to make great decisions that move you forward with confidence. And so that's why we do this. That's why we talk about this. And thanks so much for listening. We appreciate you. We appreciate the opportunity. It's our mission to help you, arm you with the information that's going to help you make wise decisions moving forward. And remember this: retiring successfully, it doesn't happen by accident. It starts with a plan, and that plan is the B.O.S. Retirement Blueprint. And you know, we love Tyson. We love helping the thousands of families that we serve move forward with confidence during retirement. And it's so fun hearing their stories about what they're doing with kids and grandkids, and that's just our passion. It's just helping you be able to do the things that you love, and let us take care of those decisions that will help arm you to be confident moving forward now and for the decades to come during retirement. Thanks so much for listening today. Look forward to sharing another conversation with you next week.